Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. We've got a good show lined up for you. During this segment, we're going to talk a little bit about how market predictions can be harmful to your wealth. And I think I need to give a disclaimer to this. We will probably come up with our 2012 outlook for the following year. It's always important that you have some sort of outlook for the future. And what we're going to be talking about is how we don't want people to, see somebody on TV and say, oh, that's the guru. He was, he made some accurate prediction, so I'm going to do exactly what he says. That's what we're advising against, is getting wrapped up in the guru status of people that, on TV making predictions. There's nothing wrong with having an outlook for the future, such as, well, we think, generally inflation will be low or stable, or inflation will be generally rising, or we think GDP will be going up. And what do those things mean for bonds, and what do those things mean for stocks? But to go, to predict, well, the Dow is going to be at, 12,150 or something like that, that's where I think you get into trouble. The reason you want to have a general outlook is when things don't turn out the way you think they are, when things differ from your outlook, that's when you need to be prepared to take some action. So if you don't have any sort of feeling of what's normal or what is going on, then you have nothing really to base that adjustment on, and you're just sort of flapping out there in the wind. But anyway, talk a little bit about some people. Jeremy Siegel is a good example. He's a Wharton professor of finance. He wrote a book of stocks for the long run. And he's a good guy. I mean, he really does. He has some good advice from time to time. But once again, even, here's an esteemed professor at the Wharton School of Business. In 2007, he predicted the economy will avoid recession in 2008, and the stock market will have another winning year in 2008. And financial stocks, which have plummeted 18%, that's 2007, will outperform the S&P 500 index. Well, we all know how that turned out. In 2008, the S&P 500 lost 38%. Financials underperformed, losing 57%. Now, I don't mean to pick on Professor Siegel, but that's an example of okay, he had this outlook, and if the year 2008 was not unfolding according to his outlook, the prudent thing to do would be to change what he's doing. For example, let's say he loaded up on financial stocks at the end of 2007, and they were not performing in line with his expectation. Well, at least he had an expectation to move off of. But the problem with most people is they'll see this on TV or they'll read it in the newspaper and say, oh, well, Professor Siegel said that financial stocks would do well in 2008, and they run out and they bought Bank of America, Citigroup, JP Morgan, Lehman Brothers, everybody. And at the end of the year, and they're over half their portfolio is gone, they sit back and they wonder, well, what happened? So it's not that we don't feel like you need to be looking ahead and trying to understand what's going on in the market, but you've got to be willing to adjust that and don't follow these blindly. There's a group called CXO Advisory Group on the web. It used to be all free. I think now some of it is subscription. But this CXO Advisory Group, I think it's cxoadvisory.com or something like that, but they do a lot of research on myths and things that are promoted out there in the finance industry, a unwritten rule or something someone says on TV. And this is one of them that they have looked at. For about 2 years they undertook this study. They looked at 5,000 measurements of more than 60 what we call gurus. These are people that you see in the press, things like that. And it found the overall accuracy based on raw forecast and average accuracy was about 48%, which is what you would expect from tossing a coin. And they took a hard look. As an example, Jim Cramer, they took a look at his stock picks. They're avidly followed by a lot of loyal fans. They analyzed 152 buy and 108 sell recommendations made in July and August 2005. Now that right there should tell you something. That's 160. That's 260 buy and sell recommendations in 2 months. And what they found that Cramer's buy recommendations likely encourage market underperformance, and his sell recommendations in aggregate may outperform the market after 6 months. And Cramer took issue with this, but the point is that you have a lot of hedge funds out there that actually watch for stuff like this. And when Cramer says sell, 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 sell on his TV show, some of these hedge funds are taking the other side of the trade because they know there's a lot of knee-jerk reaction. And Cramer's probably an unusual example. He is a very intelligent person, and I bet you if he continued running his hedge fund that he would continue to be very successful. But as I alluded to in the first segment, when you have too many people trying to follow the same strategy, typically it doesn't work out well. And that's the problem that these gurus have, is even if they know what they're talking about, when they make these, by the virtue of the fact that they're making the predictions, they're changing what is going to happen. If you have several million people that hang on your every word to follow your predictions like Cramer does, and you think that this stock is going to go down, well, by virtue of that, all these people run out and sell. They may drive the price down too low, or if he says buy, probably going to drive the price up too high. So it's not that these people aren't intelligent. It's not that they don't know what they're talking about. It's just by virtue of the fact that they make a prediction or come out in a mass media thing, they actually change the outcome. We'll talk a little bit more about this when we come back. We're coming up on our second break. So for All Things Money, I'm your host, David Blain, and we'll be right back after a few short messages.